So if we look back year to date, it's been a good year. And if we go specifically on to Q3, it's been fine so far. So we're outperforming the market marginally, I'd say, whereas on year to date, we're outperforming by quite a bit. One of the most interesting things, though, about Q3 is that we've seen a really abrupt rotation. So right at the end of the period we're talking about, so the start of September, really, the last few weeks, we've seen an abrupt shift where growth and quality have started to underperform and value has started to outperform. Is that something that's transient? Is that something that's long-term? Time will tell, but that certainly has been detrimental in the last week or so to performance, but we're still in pretty good state year to date. Look at the economic data we're seeing. When I think about the companies that we're meeting and what they're saying about the world, and when I think about the monetary policy environment we're in, I'm kind of going to say the same thing I was saying 12 months ago. I don't think it's particularly different. There are definitely pockets of weakness. I spoke earlier about semiconductors and how we're at a low point in that cycle. So that the environment, the economic environment and the economic cycle has hurt those businesses and that industry. The auto sector is another really obvious example. You know, production levels have declined. Demand is softer than it has been. And those two industries have actually been caught up in this global trade or kind of caught up with the issues we've seen with global trade, especially with the ongoing war of words between Trump and obviously China. So pockets of economic weakness, I wouldn't say widespread. When I look at the monetary policy environment, again, not a lot has changed. We've heard from the ECB obviously last week, and we saw further deposit rate cuts as well as a commitment that actually surprised people in its longevity, a commitment to open-ended QE, when most people were expecting a distinct period of time at which they'd be buying assets over. But not a lot has changed. We've got a super accommodative monetary policy, and we've got a slightly weak or sluggish economic environment, but only in pockets and not widespread. The two combined are not a terrible environment for equities. And actually, again, what you've got to overlay on the top of that is what else can you buy? You know, when you're looking at the valuation of equities and you're thinking about that compared to fixed income securities, both corporate and government bonds, where else are you getting value? Where else are you getting an attractive return? And we see equities are still pretty well placed. One of the things I would add as a final comment goes right back to the beginning of what I was saying today and talking about the last few months. There has been this recent rotation in the equity markets, and that has happened because interest rates have ticked up slightly and inflation expectations have ticked up slightly. And the key question when you're asking me about the performance of the trust and the performance of markets over the next 3 months, over the next 6 months, probably over the next couple of years, is that a transient thing, or is it something that is much more long-standing? Have we returned to an inflationary world? That is the key question.